Welcome to Multnomah Group's participant-facing webinar, Your Retirement Plan in a Pandemic. We're going to walk through today context and strategies for managing your retirement plan in the current economic market environment. First, a few things. Keeping in mind that so many are worried about the health of themselves and their loved ones, and then ultimately the financial impact that this may have on those they care about, today's presentation is going to be focused on what we consider to be a third impact, that on your retirement plan, investments, and their performance during this highly volatile period of time. For those that have been watching markets over the last several weeks, you have certainly seen and experienced the tremendous impact the COVID-19 virus has had on markets globally. If you look at performance over the course of 2019, you can see that U.S. equities, as measured by the S&P 500 index, are down over 28.5%. International markets are down well over 30%. The only place preserving capital in the current flight from risk to safety have been U.S. Treasuries. While much has been said about the performance of the broad indices and the market as a whole, many portfolios represent a much less volatile allocation. If we use as representative market perspective the Vanguard target date funds, the largest set of target date funds available in the marketplace today, we'll see that the range of returns has been significantly different from as high of a loss of only 10% for those that are in retirement to losses as deep as 28% for those that have time horizons of 20 years or longer. So while market performance is still impactful significantly to everyone across the retirement spectrum, from those in retirement to those just starting their working careers, it may not fully represent the performance that you see portrayed in the media as referenced by the S&P, the EFA, or some of the more volatile U.S. equity and international equity indexes. The challenge, of course, in these types of volatility is that humans aren't particularly well wired for addressing risk and volatility of this nature. When people follow their natural instincts, they tend to make decisions and apply faulty reasoning to their investing decisions. Frequently, they do things like blame themselves, believing they should have seen a market decline coming, and as a result may get out of the market or double down on mistakes that they made in previous market environments. Others may be overly confident in their own ability to generate returns despite the level of volatility and negative performance the market as a whole are generating. Whether you're a participant that blames yourself for the past mistakes or think that somehow you can outperform the markets as a whole, this level of market timing and volatility can have a significant impact on your portfolio over long periods of time. And that's because from a psychological perspective, investors do tend to react to the emotions they're feeling at the time. If you go back even over the course of the last 24 months, you have probably experienced some or all of the emotions relative to your investing portfolio. Clearly, during the 11-year bull market we've experienced coming out of the 2008-2009 financial crisis, many had a growing sense of optimism as the market prices continued to appreciate in their 401k and 403b plans. In early 2020 through the early part of January 2020, we saw investors in an elated sense receiving huge returns on tech stocks that appreciated year over year over year without regard to any change in earnings or appreciation there. But as markets shift, we've certainly seen that impact emotions as investors have learned more about the COVID virus. We have seen markets move into a nervous perspective, especially as the virus began to emerge internationally. And now, as we've seen its impact here domestically, we've seen full fear relative to the investment process and markets have declined accordingly. However, this too shall pass and eventually markets cycle back to optimism. The challenge is that people struggle to separate their emotions from the investment decisions they make. So while it's very typical to have emotions tied to the current market environment, what can be difficult is not reacting to those emotions and thereby potentially damaging your long-term performance. Some people approach investing from an emotional perspective and act impulsively. Their reaction is typically sparked by either fear or greed. Some may get anxious about the stock markets and decide to get out. This may ease their fear temporarily, but it'll be replaced by anxiety of missing out on the next market recovery. Investors who flee the market ultimately have to decide when to get back in. The 2008-2009 global market downturn offers an example of how the cycle of fear and greed can drive investors' decisions. Some investors fled the market in early 2009, just before the rebound began, locking in losses and then experienced the stress of watching markets climb in 2009, 2010, and beyond. What further fuels the current market is what's happening in the media. Clearly, on a day-to-day basis, with more and more Americans being quarantined at home or sheltering in place, we're spending more and more time absorbing media sources. And ultimately, media sources provide good information, but frequently focused on the most extreme information in the marketplace. Optimistic and pessimistic positions, relative health, relative markets, and relative nearly every fact pattern that we're reviewing as viewers. Reacting to that type of information can also inflame or make more difficult managing your own investment emotions that a normal person would have in a time of market volatility like the ones we're experiencing now. Very few say that this is a time to be balanced and disciplined. It's far more interesting to say it's either the greatest time to invest or the worst time to invest. And simultaneously, you'll find experts on both sides of that argument coming to entirely different conclusions utilizing the exact same data and information. It makes it even harder for an investor to discern or make decisions about how they should react relative to their own retirement portfolios. We have no control over how markets perform as investors. However, there are things we can do to control how we position our portfolio and how we react to the information we receive. Clearly, during these times of heightened market volatility, it's important to continue to evaluate your investment plan, your time horizon, and your risk tolerance. Risk tolerance is tremendously difficult to assess in a market that has been appreciating as rapidly as ours has over the course of the last 11 years. Conceptually, you may think you would react well to a declining market because you have a long time horizon. Now, however, as an investor experiencing a declining market and experiencing the emotions connected to that, your reaction may cause you to reevaluate or reassess your true risk tolerance. Clearly, taking a look at your time horizon, whether this market decline has impacted that time horizon by extending it, or whether you continue to be near retirement and you need to shrink your exposure and protect what is already adequate for retirement. Reassessing those dynamic elements to protect what you have in place and evaluate your long-term strategy is important. Once you have done that, you really need to structure a portfolio that provides you the opportunity to maintain that discipline over a long period of time and through highly volatile markets. There is likely going to be a significant level of market volatility in the global markets for the foreseeable future. Being sure that you can adjust, react, and build a portfolio into a normalized structure is important. It's also important that at these times, we evaluate our portfolio and make sure that we've reviewed the global balance of the portfolio and aren't protecting ourselves in geographies or industries where we may feel more comfortable our staying. While that may feel like the right solution, it may have the effect of actually increasing your risk exposure, concentrating your portfolio, and potentially increasing your amount of volatility. Additionally, investors already struggling in a down market should continue to do things that limit the cost that they may incur. And most important, staying disciplined through these market dips, as these too shall pass. Over what period of time is impossible to say, but putting yourself in a position to benefit as the market recovers and the economy returns to a more normalized state will help preserve what you have accumulated over whatever the working time horizon has been up to this point. While it's certainly tempting to try and predict where the market's going to go next and to take advantage of small swings on a day-to-day basis in the markets, what we find is that over long periods of time, trying to pick the fastest lane or investment is actually a very stressful guessing game. At a time where most participants are experiencing immense amounts of stress relative to other topics not related to their portfolio, and from an academic perspective, it's clear that those that try and take these short-term approaches to picking small returns in the short run end up accumulating a much lower return over the long run. Timing, finding that correct lane at the correct time, is virtually impossible in a rapidly changing market. This is important because as we look at markets, we tend to think of markets over long periods of time from a retirement perspective, which we should. However, the impact of missing some of the best performing days, even over a long market cycle, can be highly negatively impactful to returns. Here we're looking at the performance of the S&P 500 index on a 28-year period of time. If you look at the 28 years from 1990 to 2018, the S&P generated over a 9.3% compound return. Very strong, despite the fact that the market went through several bear market cycles during that 28-year period. Had you have missed just the best day between 1990 and 2018, that would have reduced your return by almost 0.5% a year. So a cumulative return that accumulated $11,700 on a $1,000 investment 28 years ago, instead of achieving a $13,000 compound return over that same period of time. Let's say you missed the 5 best days from over that 28-year period of time. Now you've reduced your return by well over 1% a year and reduced your compound dollars accumulated by nearly 5,000. And if you had missed the best 15 days of the year, you now cut your return in half over a 28-year period of time. 15 days meaning only 1 day every other year over that period of time. Markets adjust much more quickly than human investors do. If you look back to the 2008-2009 market environment, many who are listening to today's webinar probably lived through that particular market decline and bear market cycle. When we came out of it, there was no clear sign that markets were going to recover after the decline of US equities that was well in excess of 40%. When it recovered, those first few days of the recovery were significantly impactful, and it happened almost immediately. Many investors who may have exited the equity markets during 2008 and early 2009 didn't choose to return back to those same markets until 2010, 2011, and even beyond. The impact of that decision was a significantly reduced return over the entire market cycle. Markets react much more quickly than human investors, and by missing out on those recovery points early on in the market cycle when things change, it will have a significant impact, even over a 30-year working career. It's also important to point out that stock volatility performance is inherent in the investing process and will be wildly different from day to day and year to year. Investors who do well to consider volatility as a normal part of the investing process. This graph displays the returns of the Russell 3000 index since 1979. The blue bars show the return for the entire calendar year. The black and red whiskers show the largest gain and decline during those years. Even in years with high calendar returns, a large intra-year decline may have occurred. The performance for any given time period does not need to prompt action. A long-term focus can help block out that noise. And this looks at the annualized performance of the US equity market over the course of the last 90 plus years. And from a long-term perspective, what's important to keep in mind not is the magnitude of any 1 year's loss or gain, but the larger picture as to the frequency of gains to losses. So while markets have largely appreciated over the last 11 years, if we look back over a much longer cycle, what we'll find is that roughly 3/4 of years, markets tend to appreciate, and 1/4 of years, historically, it's declined. So while we've been through a continuous long bull market cycle, negative periods are inevitable, but owning equities and securities over long periods of time balances out more wins with less losses to generate better accumulated returns. It's difficult because news and financial commentary can clearly influence participants' view of the investing process. So having a strong investment philosophy to guide you, and then avoiding the guidance that comes from friends, from neighbors, from family, and especially the quote-unquote insight promises of fast and easy returns. Growing a retirement portfolio that's successful and sustainable has no shortcut. Success requires a solid investment approach, a long-term perspective, and the discipline to stay the course, and the consistency to continue making contributions, even during times where it may be difficult to do so. If we look at this particular crisis in the context of some of the others that we've experienced over the course of the last 40 years, what we will find is that market declines are material. If you look at a balanced portfolio of stocks and bonds, not one that is overly aggressive or overly conservative, but a 60-40, 60% stock, 40% bond portfolio, what we find is that over relatively short periods of time, markets do recover, and they recover completely. So looking back at the stock market crash of '87, the dot-com crash of 2000, or the bankruptcy of Lehman Brothers in 2008, over a 1-year period, things continue to be painful. Over a 3-year period, we begin to see growth, and almost without exception, over a 5-year period, markets recover and normalize. They only can recover and normalize if you maintain exposure to the securities that make up those allocations and that ultimately drive performance. This is going to be a critical piece in determining how well your portfolio holds up during this period of transition. We thank you for listening, and we hope this information is helpful as you make decisions about your portfolio. We wish you all the best of physical health and good financial health. Thank you for your time.